Good evening. I'm Susan Moon, Executive Director of the Walnut Creek Library Foundation, and I'd like to welcome you to the third and final Finance 102 program, Investing During Uncertain Times. I'd like to thank our masterpiece sponsors, Kathy and Jerry Hicks, as well as our media and print sponsors, Diablo Magazine, East Bay Times, and Minuteman Press Lafayette. I'm pleased to welcome tonight's speaker, Annalise Morris, a Vice President and Wealth Management Advisor with Merrill Lynch. Annalise has been in the financial service industry since 2015, working with high net worth families and small business owners to help achieve their financial goals. Annalise's focus is on developing long-term relationships through strategic wealth planning, personal retirement analysis, and professional money management for her clients' unique needs. Tonight, she will guide us through investing in these unprecedented times. She'll focus on wealth accumulation, long-term goals, and how to manage your assets through diversification. Annalise will also review different strategies available to you in this changing environment. Following her presentation, we will have a brief Q&A, but you're welcome to submit your questions at any time in the Q&A box below the screen. If you enjoy tonight's program, please consider making a donation to the Library Foundation to support us. Visit our website at wclibrary.org or click on the link located in the chat box to donate. Now, please join me in welcoming Annalise Morris.
Hi, Susan. Good evening. Thank you so much for having me. And I look forward, the timing could not be better on this presentation. I know a lot of people are feeling, the uncertainty that's out there in the air. So I hope everybody is able to walk away feeling with a little bit more self-assurance and having a little bit more direction in terms of a forthcoming plan. So I'm going to pull up my slides here. Bear with me one moment. And we can hop right into the presentation. Perfect. So as a certified financial planner, kind of the cornerstone of my practice and what I do with my clients is ensuring that we have a great foundation and a great plan set up. Really helps alleviate any of the risks and issues that arise with, a volatile market situation. If we have everything right from the get-go and the plan is set up and everything is properly allocated from the get-go. So what this entails is identifying, what matters most to you, and then understanding and evaluating what you think and feel about investing. And as soon as we have a little bit better understanding of those two things, we can kind of begin the process of determining one's financial profile. And some important factors that factor into this are time horizon. So how long we have until we need to utilize this capital, needs, what specifically does that look like? And then also the individual's ability to accept risk, and then what their current income looks like and what their future income is going to look like. So taking all those into consideration are kind of the baseline of creating a plan. So then from there, it's really important to figure out based upon what is most important in each individual's life. And so what I found is there's 7 main categories that kind of all encompassing of what one's financial needs are, and taking a little bit of time to really dive in and figure out specifically what those are. So just to walk through this really quickly, as for example's sake, so with health, one that comes up pretty frequently is long-term care. A lot of people nowadays living longer with longevity, they have to make a tough decision of how they want to spend the final years of their life. And some people have, very certain standards and vision of what that should look like, and funding that and making sure that if, say, they want to age in place and they want to live in their home, making sure that that is fulfilled and they have the adequate resources necessary to do so. Medical bills, that can be another contributing factor there within health. Home, again, staying in place and aging in place, that can be a very important top of a lot of my clients' list. Maybe eliminating a mortgage is a goal for them. Buying a vacation home, or even relocating during retirement. Those are some of the common ones that we plan for and incorporate into their specific individual plan. Family, leaving a nest egg to future generations. That's a pretty common goal that we see, as well as education planning and make sure there's the resources necessary for children and grandchildren, and even in some cases, great-grandchildren, that they're able to get the education that they desire. Travel is probably the top one we see under leisure, and making sure that those travel goals, we've worked so hard our entire careers when we're in retirement and then have the time that we're able to take advantage and do the sorts of things that we want to do. In terms of giving, there's, being a part of this great organization and foundation, this should be pretty self-explanatory, but also, philanthropic endeavors, participating and giving in both a time and financial sense to meaningful organizations, and, really feeling like you're making a difference in the world. That can be paramount in many people's lives. Work, the big one here we often see is retiring early, or at what point in your career you're able to actually retire. So kind of planning accordingly there, or in some cases, taking on a second career, making an adjustment, doing something different, and, being able to do that financially. And then kind of last but not least, finance, that kind of encompasses everything that we didn't already touch on. Really ensuring that you have enough, and that can be kind of arbitrary and can mean different things to different people. But what I found is, through wealth accumulation and working, we kind of get to this point where we have this, set amount figure that we're getting to in our mind. And by completing the planning process through a financial planning exercise, but then also finding that peace of mind when you get to the point when you feel financially secure and that you're able to not take on undue risk because you have enough resources to fund the remainder of your life goals. And also additionally, there is making sure that you aren't outliving your money. Because as we know, generations have continued to live longer and longer. And one of the greatest risks that we now see is, living beyond a point where you don't have enough resources. So then once we've kind of taken all of this into account, we begin the financial planning approach where we kind of quantify and structure the plan. So the first step in this is really ranking in terms of priority. So the relative importance of each goal. Is this essential? Is this going to ensure that I can pay my PG&E bill for the rest of my life? Or is this an important goal? Am I able to take a vacation each year for the rest of my life? Or is this aspirational? I'm able to take a cruise to Europe every year for the rest of my life, and kind of quantifying the basic needs and then kind of level on the importance and, maybe what a best case scenario would look like. From there, determining a target value. So how much will this cost us? As we know, in the future, dollar today isn't necessarily worth a dollar tomorrow. So making sure that we have the ability to fund that. And as I mentioned earlier, time horizons are getting longer and longer. I think a great example is in previous generations, no one in my family had really lived beyond their 70s into their 80s. But I have two grandmothers that are still with us, and they're both in their mid 90s. So that's something that's important to me, as well as my husband, kind of in the same situation with two grandparents in their 90s. We know looking ahead, there is the potential that we could have a very long life, and planning accordingly to have the resources and able to have a good life for the duration. So once we kind of determine what that target value is, determining what that time horizon would look like. So if you have a child that's going to be attending college in a year from now, obviously the way that we would allocate those funds would be very different from a retirement account that you're not going to access for 15, 20 years. We would have different goals and different time horizons and different asset allocation there. A good example, I went to see my doctor earlier this week, and since this is kind of top of mind for everyone, he asked me, what are my thoughts, and he thinks he's a little too aggressive in his retirement account. And I obviously, like, being there at the doctor's office wasn't the opportune time to have this full-on discussion. But I also reminded him, it totally depends upon when you plan to take the money out of your retirement account. If the money, isn't going to be touched for another 10 years or so, it doesn't necessarily matter what happens this month or next month, because, you're going to have no need for that, for liquidity, and you're probably better off staying the course. And then lastly here, kind of taking into consideration these 3 prior steps, then really kind of evaluating and determining what an acceptable level of risk is for pursuing that specific goal. Kind of going back to the previous slide, again, if it's a essential goal, making sure that it's your mortgage payment, your healthcare costs, things that are non-negotiables that you're going to need to fund, taking a little bit less of a risky approach. And then if it's a little bit more of a stretch goal, if you will, maybe taking on a little bit more risk in that certain situation. So then, once we've kind of cultivated and created what the individual plan looks like for you and your needs, and everything that's important to you in your life, it's really important to stay on track. And what this means is evaluating yearly, I would say at a bare minimum, reviewing what's going on. As we know, lots of things can change even from one year to the next. I think we've constantly been reminded about that over the past 18 months or so. And then making updates. If there are life events that are occurring, really taking that into consideration. I know a lot of people with COVID, it's made them reassess when they want to retire. And, maybe they had a 5-year time horizon, but now they're looking at now or 2 years from now. And that would obviously be a material change and would make, a potential allocation change in your portfolio, in addition to maybe altering and modifying your financial plan. And as I mentioned before, really important to do this exercise to stay on track at a bare minimum once a year. And I would say, quarterly is probably a good amount of time, because at the end of the day, you never want to be losing sleep or feeling anxious. These things need to be put in place properly and methodically, before we see an event that would potentially cause anxiety or fear. And that's a really important part, because a lot of times good decisions are not made in a time of panic. And which actually segues really nicely into this next slide. So probably at one point or another, we've all kind of rode this emotion in terms of investing. And if you are kind of riding through this roller coaster of emotions, I would venture to say that your allocation is probably not correct to your level of risk tolerance, and that some changes should probably be made in anticipation of the next potential bout of market volatility. Again, things are set up properly in advance, and each goal has a specific portfolio earmarked for that specific responsibility. It really takes a lot of the fear and a lot of the anxiety out of investing. because you know that you have a certain amount of near-term funds that will be readily available if and whenever you need them. And then you have a longer-term approach that can withstand some market volatility. So then if we move forward to this page, there are several different kind of behavioral finance aspects that we tend to feel over the course of investing. There can be overconfidence. So this is kind of having an extreme level of confidence in investment abilities. And sure enough, this is always in a positive market cycle. And it tends to erode in a time of market volatility. We also have the tendency in terms of recency. So we tend to always remember, last year when COVID hit and we saw a 30-point market correction, because that was kind of the last market volatility that we experienced. We tend to associate it with what happened most recently. And then, of course, there's emotion. So making impulsive, reactive decisions. And then, unfortunately, this is often linked to buying at a high point and selling at a low point, which, as we know, is kind of the worst possible thing that we can do in terms of investing. And so having a disciplined approach and not letting emotions come and interfere with our strategy is super important. And then lastly, I know that this one is kind of hard to overcome, especially I hear it all the time from clients, herd behavior. So this is, and I heard it earlier this week, my Mahjong group, when we got together last week, we were worried about the stock market, or I was talking to my sister and XYZ. And so again, having the proper plan in place kind of eliminates this fear and anxiety, because we don't really care in that situation too much what's going on with everybody else's specific situation. It's great small talk, we can sit around the table, but it won't spawn any fear or sudden need to change course, because everyone feels comfortable with how things are set up. And we know that in advance of anything happening, we have the right plan in place to get us to where we want to go. So again, then really, after we've created all this, quantifying and qualifying what our most important goals are. So what matters most, staying on the path, making it happen, and then reviewing the progress, and not letting us pull our own selves away from what we've already established. Kind of just an interesting anecdotal side note. So oftentimes, people have a vision, right? I'm going to be retiring in 5 to 10 years, and I want to, I had one client a few years back, it was super important to her. She was working very hard. Material things were a little bit more important to her while she was working. And so she had this list of kind of aspirational goals. She wanted to buy a luxury car. She's very into antiques. So she wanted to be able to buy the antiques that she wanted to buy at auction. And she also had some aspirational plastic surgery goals. And while she was working, these were super, super important to her, and, couldn't be talked out by her husband, her kids, me, no one. And, after she retired and her life slowed down a little bit, and she wasn't kind of in the rat race of work and coworkers and, fancy trips and all of that came with her kind of high stress, high powered job, suddenly all these aspirational goals no longer appealed to her. So oftentimes we find this, remodeling her backyard. That was something that was more important to her. And, we reevaluated and changed course, but, we're able to make that happen because we had the money set aside in advance. So then last but not least, in terms of the goal planning process, and then we can step into a little bit more current market conditions and, future market outlook, making sure that we have a plan in place and having the goals quantified. So then the conversation shifts away from, are we making progress to my specific goals? are we on track to achieve the future lifestyle, the education goal, whatever it is that is important to you. And it becomes less about, the market and it more about my specific living situation. And, year over year, are things getting better? Do I have a better margin of safety? Do I need to spend less money? Do I need to save more? And it takes away this fear of, what happens if the market corrects. It's, I'll still be able to pay all my bills. I'll still be able to take my vacation, and I know that, and I feel comfortable with that. So then, as I mentioned before, kind of shifting gears into the market. So this looks very confusing. There's a lot going on here, but I promise it's not. So this just breaks down the historical asset class winners and losers since 2001. So just to kind of level set for everyone going forward, I'm a big proponent of diversification. We don't want all of our eggs in one basket, and to have the correct financial plan for just about everyone, it's not going to be a one size fits all approach. However, it's going to look similar for most people based upon their goals, and it's going to be achieved through, various investments, time horizon, as we mentioned before, and making sure that there's some stability and balance there. So the only thing I really wanted to highlight here is, so if you look at this, this top light blue box, this encapsulates small stocks, so small companies. And as you can see, since 2001, it's been a little bit of a roller coaster ride. You have some really high performance in 2001, and then 2002, some significant downturn. So over time, you have high highs and low lows. And this can be a lot to stomach for just an individual investor. So having a little bit more of a blended portfolio approach, it's kind of that old adage, the tortoise and the hare. You're never going to be beating the market. And in most cases, that's not what most people are setting out to do. But it's less of a wild ride. And we're seeing moderate returns, and in some years, some substantially good returns. And we don't have all of the inherent risk of having all our eggs in one basket or one asset class. So as I just mentioned, making sure that we have a blend of both growth and value is an important part of investing. So most of you might know this in terms of dividend paying stocks, in terms of value, and then growth would be companies that reinvest their dividends and continue on a faster paced growth trajectory. So having a balance of both is important, because as we've seen over the past few years, certain market sectors have really performed well, while others have kind of underperformed. So having a balance of both is very important, and making sure that we have that mix right, based upon what can potentially happen in the market. The other thing I wanted to add here too is also sort of important. It can be risky to be overinvested. So always having, a small amount of cash on the sidelines can be great for two purposes. The first of which, if there is a market pullback, it gives a good opportunity to get into the market. So going back to March of last year, we saw a pretty historic pullback within, a month and a half. We had a 30% downturn in the market. Obviously hindsight's 2020, but that was a perfect time if you had some capital to put it to work, get in a low point, and then it's done well. So that's one important aspect. But then additionally, having cash. So if you have, an unexpected expense that comes up, need a new car, need to put a new roof on your house, have some unexpected medical bills, you have the cash available to fund that, and you aren't having to sell out at an undesirable time in the market. This next slide too, it shows the returns of stocks, domestic stocks, so US stocks, over market recessions and the correlation between bonds. So, one thing that's been rather difficult over the last year and a half is bond yields are historically low. So it's not exactly the most attractive investment for most. However, one thing that's important to bear in mind is it's not necessarily all for the return, and having a ballast in safe investments is super important to an overall financial plan, because as I mentioned before in the previous slide, we don't want to have to sell out of equities at a low point in the market. So having some money on the sidelines in cash and fixed income is really important to be able to fund those goals in the near term. But then additionally, since there is a reverse relationship between stocks and bonds, when we see volatility and a sell-off in the stock market, the bond market increases in yield. So it's an important part of a balanced portfolio to have both of these aspects. So a lot of times it can be very tricky to quantify someone's exact level of risk and their exact risk profile. And there's kind of no perfect way to do this other than to make sure that you have the ability to endure, X amount of loss if we do see a market downturn. So as we can see here, we have some pretty significant historical downturns going back to 1993. So, December 2002, we saw a 47% drawdown from peak to trough. And in 2009, we saw 55% downturn from peak to trough here as well as most recently, as you mentioned before, we saw the 20% downturn in the end of 2018. And then at some point soon, when we have more data, we'll see the COVID correction that we saw earlier last year. So making sure, because we know there's inherent risk in investing in the stock market. We know that there are going to be times when the market goes down. But, if you have $1 million portfolio and the portfolio has the ability to lose 55% on the downturn, if we see a correction like we did in 2008, and that's going to be too much of a loss for someone to stomach, or you don't have a long enough time horizon to ride it out, it's really important that you have that mix right, and you're not all invested in equities. Having 50% of that portfolio in fixed income would insulate the portfolio. And instead of seeing a 55% drop, you would see somewhere in the neighborhood of a 20 to 25% drop. And that might be more appropriate. And at the end of the day, no one should be losing sleep over how their portfolio is doing. And there should, in a perfect world, there shouldn't be panicked phone calls, into your advisor, or if you manage your own money, panicked logins looking at how your account's doing. This should all be set up well in advance, so we're not making reactionary changes, which is really, what comes back to hurt us in the long run. So in terms of quantifying risk, there's 5 major risk profiles, if you will, ranging from conservative, moderately conservative, moderately aggressive, and aggressive. It totally depends upon each individual circumstance and what their goals and time horizon are, as I mentioned earlier. But this is helpful in terms of kind of helping to determine where someone falls along the spectrum. I tend to find a lot of my clients who are either entering into retirement or already retired and drawing income from their portfolio kind of fall somewhere within this like moderately conservative to moderately aggressive kind of band, if you will. There's other factors, if you have a pretty substantial pension income, that could be something that could allow you to be a little bit more aggressive. Obviously, having a little bit more of a longer time horizon is something that could impact that as well. And then just kind of individually tailoring that based upon the amount of equity exposure and what everyone feels comfortable with is really important. Again, doing the homework and the legwork and having this done in advance of volatility is the most crucial step. So I included this. It's pretty similar to that asset class performance that we saw a couple of slides earlier. But one thing that always kind of comes up and, tend to get asked, especially in times of volatility, is what about gold? And, it's a great question, but I do always like to remind people that gold is a commodity and there is a lot of inherent risk because the fluctuation in the value of the price of gold can change based upon market conditions. So kind of to add some context to this, if we go back to 2009, obviously a strong rally in light of the financial crash of 2008, and we saw some stellar performance. But then, so up 16.8% in 2010, but down 13.3% in 2011. 2012 was a good year in the market overall, but commodities underperformed, down 1.1. So that's just kind of a cautionary tale. I feel like I see these commercials on TV and, they're touting gold and how, there's so much risk in the stock market. You need to put your money in gold as if it's this magic bullet. Not always the case. So, and then in addition to that, we break down other asset classes here. So, there's also some other forms of investments like real estate investment trusts, relative performance to cash, United States fixed income, the MSCI emerging markets, and you can just see over time in different market conditions how each historical asset class has performed. So then kind of switching gears a little bit, I kind of alluded to this a few slides back, but one of the things that really can present an issue is trying to time the market. And this is, kind of jumping in and out of and making all or nothing bets on what, is going to happen in the future. And I like to tell my clients, we're investing alongside the investments that we invest in. We're not making speculations. If you're investing in some company that's about to go public, there's a lot of volatility. It could work out very well in intraday trading. There could be, a lot of upside, but there could also be a lot of risk and downside. And so in a solid portfolio and investment strategy, we're not making all or nothing bets. We have diversification. We're represented in different industry sectors, in different asset classes, and it really needs to be more of a long-term strategy. Otherwise, if we're hopping in and out of stocks, there's really not too much of a difference than, going to Las Vegas and hitting the blackjack tables. And that can be evidenced here, where we see what the return. So this is if you had invested money from 2001 to 2020, so pretty representative, a 20-year time horizon. Over that course of time, you'd have a 7.4% return cumulatively if you're invested for all of the trading days. So then if you peel back the onion a little bit and you missed the 10 best days in the market in that same time horizon, your return is cut in half. So kind of hard to, be right. Sometimes people can predict the downside risk of the market. They can get out at the right point in time, but there is a lot of risk in not getting back into the market at the right time. And you can miss all of the upside or most of the upside on the market. Kind of this situation going from bad to worse. If you miss the 20 best days in the market, your return is down to 0.7%. So barely, so not even 1% at that point. The 30 best days, you're actually at negative return territory. And, 40 days, it continues to get worse and worse. And by only missing the 50 best days in the market, you're already down almost as much as what you would have been if you just conversely, if you had been stayed invested for the entire time. So one way to make sure to avoid this, because that can be one of the most costly things that investors do, is making sure that we have the mix right. And, ultimately hoping that we have the ability to sleep well at night. We're not losing sleep over how our portfolio is doing. And that comes in large part to these critical steps. So making sure that we have the asset allocation correctly. So how we choose to invest among different asset classes, super important. That goes back to, having a mix of safer investments as well as appreciating investments, some exposure to the stock market to help us grow the portfolio over time. Having diversification. So having different representation within those specific asset classes is also very important. And then, having a rebalancing strategy. So, the market's done very well the past few years. There's been a lot of growth on the equity side of the portfolio in most cases. Maybe tailoring back, harvesting some of those gains and staying back in line with the initial strategy that was set up. If the equity exposure grows from 50% to 60%, and continues to go up from there, at some point we're no longer moderate, we're going to be more moderately aggressive or aggressive. So kind of staying in those parameters in which we've established is also super important, because ultimately we want to be able to stay the course. So kind of taking a little bit deeper dive into diversification. There's subsets of diversification within the three major asset classes we just reviewed. So having geographical diversity is super important. So having some domestic exposure as well as international exposure, that can be a super important part of having a well-balanced portfolio. We mentioned this a little bit earlier, but having equity style, so having value. So, companies that pay a dividend, that provide that stability and long-term income stream, in addition to growth-oriented, is important there. Having a representation of small companies, mid-sized companies, large companies, because there's different level of growth and volatility just within those three different sectors. Having representation across different industry sectors. A good example, not to pick on COVID, but it's just, again, the most recent example. Certain companies did very, very well over the course of the past year, and the overall market did really well. But there are also some industries that were hit very hard by COVID. Anything in the travel space last year. So cruise ship companies, airlines, hotel companies. It was all a very difficult year for them because no one was traveling. But then conversely, technology companies, we saw, Zoom, like how many people even knew what Zoom was before March of 2020? I'd probably venture to say, at least a few people on this call, financial companies, retail companies, consumer staples, having a representation across many different equity sectors is really important, because as we know, they can respond differently and are impacted by economic events very differently. And then within the fixed income sectors, corporate bonds, municipal bonds, and then government bonds. And then also kind of a subset within the corporate bonds, having investment grade bonds, so good credit quality, and high yield would be, you've probably heard the term junk bonds, or lower credit quality. So going to pay a little bit more, but not necessarily have the security that your principal is safe. So that's kind of an important cost benefit analysis to weigh there as well. So moving forward, so keeping your portfolio in balance. As I mentioned, this is a very critical step, because things can drift, things can change over time, and making sure that we have a disciplined approach and are rebalancing based upon, what the market's doing. So in my example that I previously gave, when you have a few really strong years in the market, making sure that we're staying within balance and we haven't seen too much growth into that's pulling us out of the strategy that we set out to have. But then also life changes are super important. So, has anyone lost a loved one, retired, sent their kids to college, had the kids graduate from college, had a major medical situation. And so making sure that we're kind of adjusting based upon those changes as well. It can be critically important. So I like to cover this, especially right now. A lot of us are pretty familiar with the concept of dollar cost averaging. You might not all know this, but instinctively you are. So, everybody through probably their employer or at some point in their career has been exposed to having a 401k or some kind of retirement planning vehicle. And within that, you get paid every week, every 2 weeks, every month, whatever the payment schedule is, and then tucking little pieces of money away over time, scrolling away money over time, and kind of using this approach, you're taking advantage of high times in the market as well as low times in the market. You're not changing the amount that you're contributing, you're staying even keel, so you're taking advantage of low points and high points over time. So this is kind of an important principle that, if someone's coming to me now and say they have a lot of cash to invest, we don't necessarily know, I wish I could say that I have a crystal ball and I know exactly where the market's going to be a month from now, 3 weeks from now, 3 months from now. But we don't know. We know trends. We know kind of where to look, overarchingly, where things are headed, if there's fear or reason to be worried, or, everything looks great. But if you have a large amount of cash to invest, usually a really good strategy to take and a good approach is to not, kind of put everything to work right away, but use this process of dollar cost averaging. I had some clients, new clients that came in the end of last year. They were really worried about what was going to happen in the economy, what was going to happen to the election. That was kind of top of mind to a lot of people at the time. And in order to kind of mitigate risk, we established a strategy of, okay, we have X amount to invest. We can put the safe money, the money into fixed income to work right away because we're not going to see the volatility there. But in order to get you to participate and feel comfortable in the stock market, we're going to put X amount to work over the next 6 months. And that alleviated a lot of fear. In hindsight, it probably would have worked out a little bit better if we just put it all to work right away, potentially. However, that wasn't going to allow them to sleep well at night. So kind of having a strategy, putting it in place, everybody was happy. Nobody, no panicked phone calls. Everybody felt good. So that's an important kind of tool in the toolbox to invest a large amount of cash in a principle that we're all pretty familiar with. So then, again, risks. So we know kind of lurking behind every corner that there are some things that can present issues on the horizon. I think it's kind of a good thing to recap what those could potentially be, know that they exist. And again, an important part of having a well-balanced and diversified strategy. So volatility risk, this really generates from having derivatives in the portfolio. So not necessarily applicable to everybody, but market risk, this is something that we're all probably familiar with. This is the risk of the stock market going down. Inflation risk, this hasn't really been a hot topic until this year, but as we know, it's now more expensive today to buy things than it was a year ago. So making sure that we're not, if you're 100% in cash, there is risk there because your dollar last year was not worth the same as what your dollar is worth today. Interest rate risk, we really see this with bonds and bond reinvestment and being able to get the same rate of return, in the future that we have been able to at the current moment. And then currency risk, if we have investments becoming more, kind of a global economy, how is the currency in other countries and the increase in fluctuation, decrease in value, how is that going to affect our investments? So in terms of just overall volatility, we looked at the spectrum of risk profiles and risk based upon, moderately conservative, et cetera. So kind of breaking that down in terms of asset classes and what that looks like. So, moving from the low end of the spectrum, we've got cash and cash alternatives. So that's going to be your money market accounts, your cash, your CDs. So low level of risk. But as we saw previously, there is some clear and present danger of having a little bit too conservative of an allocation. You're not going to be able to stay ahead of inflation. Kind of moving up the spectrum one notch, increasing the risk, but still on the conservative end of the spectrum is fixed income investments. So that's going to be high quality bonds with good credit ratings. Then large cap equities. So these are going to be large, well-established companies. You might have heard the term blue chip stocks. That's going to fall into there. And then kind of ratcheting up the risk a little bit more are going to be smaller, mid-cap, less established companies. International equities, they can hold a different level of risk just based upon being foreign and maybe not having full financial disclosures, or geopolitical concerns can be an issue there. Next, small cap equities. So these are going to be really small companies. So think, startups and companies that are still establishing themselves. There's obviously a little bit more of a higher rate of return in some cases, but it comes with the increased risk. And then lastly, emerging markets. So these are going to be, international equities that are tied to developing countries. And there's obviously a lot of political, geopolitical risk there. And, kind of similar to small cap equities, they're still growing. So there can be potentially a high rate of return. However, there is a sizable amount of risk. So just good things to keep in mind when building out a well-rounded investment strategy. And so kind of reiterating what we just talked about, but then additional risks to take into consideration. So reinvestment risk, as I mentioned before, with your fixed income investments, being able to reinvest them at a point in time and getting the rate of return necessary, that's always a risk there. Issuer company solvency risk. So with fixed income, you own a bond in a company, are they going to be able to pay you? And a lot of this, knowing the credit quality of the bond, and this is, the side note I mentioned earlier about, junk bonds, and high yield bonds, you can get a higher rate of return. But in terms of investing in fixed income, it's really important to know that you're going to have the principal due when it is come due to you. If you invest in a CD at a bank and there's only, less than 50% chance that you were going to get that principal back when the CD redeemed, probably would make you reconsider investing in that. And additionally, liquidity risk. So we see this with like real estate investments where money's tied up and you might not necessarily have access readily available to your capital. Hedge funds, there tends to be a lot of liquidity risk there as well. And then lastly, political risk. So new legislation that might adversely affect investments. That's always something to consider. And then foreign government changes that might affect overseas investments. There's an increased level of risk there as well. So to further drive home the point that we mentioned earlier about the dangers of market timing, there's a lot going on in that previous slide. But I think that this is very understandable and kind of boils it down to a very simple form. So if you'd invested $1 from 2001 to 2020, nice 20-year time horizon there. This shows what the return would have been if you held on to the stock for the duration of the time period. This shows us if we neglected to be invested over the best 14 months in the market. And what's really interesting here is, so treasury bills, for those not familiar, so this is like a short-term government bond. So low level of risk, but also, pretty low level of return. So if you are hopping in and out of the stock market, the level of return is actually a few pennies less than what your return would have been if you just would have stayed invested in a T-bill for 20 years. So it kind of helps put that a little bit more in perspective. Lastly, I wanted to leave things on a positive note for you guys, because I think that there are a lot of reasons to feel good and to feel excited about the future and everything that's going on, and there's opportunity for growth and for things to positive days ahead. But two things just to highlight here is, so this goes back to 1926. So we can see kind of how performance has been on different asset classes. So we've got small stocks, obviously highest level of risk, but also highest level of return over that time horizon, large stocks, and where they've performed relative. So a little bit less, but there's still some very strong performance over the same time horizon. Government bonds. So these are going to be like long-term government bonds with a 30-year time horizon or so. So a higher return than the treasury bills that we just talked about, which are going to be a year or less maturity. But then what starts to become an issue over time, and what we've been, the unfriendly reminder that we've received in 2021 is that our purchasing power does erode considerably over time in inflation. So, the return that we would have received over the almost 100-year time horizon here in treasury bills, we'd barely be staying ahead of inflation. But given that same time horizon, obviously more risk, but the return in small companies levels out, as well as large companies levels out over time. And you can, just to reiterate, as long as you have a long enough time horizon, you can withstand a negative market cycle. And having that longer term approach to investing, no one should be thinking they're going to double their money within a 1-year time horizon. Anything that sounds too good to be true always is. But slow, as I mentioned earlier, slow and steady wins the race, and having a long time horizon and being patient and being able to weather the storm and stay invested is really how money and wealth is accumulated over time. And then, as promised, I wanted to leave things on a positive note. One of my favorite quotes is, when is the best time to plant a tree? Well, of course, it was 20 years ago. So the tree is, growing and full and robust and established. So the same principle holds true in investing in the stock market. When was the best time to invest? A while ago, when you had a long enough time horizon to be able to reap the benefits of the market cycles and being able to stay invested. So this comparison, I think, is just a good friendly reminder. Save early and often. On Investor A, they contributed $2,000 over the course of 10 years, starting in 2001 to 2010. And then Investor B did the same, but they started contributing 10 years later. The return is just about double with the investor starting 10 years earlier, saved the same amount of money, but just had the advantage of time continuing to work for themselves and didn't have to put a penny more aside for the remainder of the time horizon. So if there's anything that I can leave you with before we hop into the question and answer portion is stay disciplined, establish a great plan, stay the course of the plan, revisit the plan and evaluate and make changes as necessary. But I think when we take a little bit of the emotion out of investing and we have a sound strategy in place, it in a lot of cases for people, it becomes a lot less emotional, a lot less scary, and easier to ride out times of uncertainty, as we've seen over the past year or so. So that concludes my comments.
Great. Thanks, Annalise, and thanks for giving us the base or the fundamentals of investing. We do have a few questions, and the first question is actually a perfect segue. What's the best way to begin an investment strategy and financial plan?
That is very appropriate and timely. So I think, like I mentioned in the beginning of the presentation, to really, sit down and kind of establish what exactly your goals are. As I mentioned earlier, some common goals, if you will, are retirement. I don't think anyone in the audience wants to work forever. And if you already are happily retired, congratulations. But that tends to be a big goal that people set their sights on. For other folks, it could be buying their first home. It could be education planning for children and setting up a plan. So I think to identify what it is that you want to do, and what the goal, and then set a plan in place from there, is the best thing that you can do. And then be aggressive. Some of the best advice I've ever received personally, when I was younger, is save until it hurts. You give up that $5 a day coffee, or some of the other like luxury expenses that we take on in our day-to-day life, and you'll be amazed at how much just setting aside an extra couple of dollars a day or a week over a longer timeline, what that can amount to.
Thank you. So the next question, I think is for families with kids who are thinking long-term and thinking about college. What are some strategies for educational savings and planning?
Great question. So that kind of, after you identify the goal, then kind of diving a little bit deeper and establishing a strategy. So there's several different ways that this can be done. Some of the more common ways are setting up an educational, 529 account is a tax efficient savings vehicle. There's also some other savings accounts like universal transfers to minors accounts, where you can gift money to children and invest the funds. And there's a little bit more latitude there on how the money can be spent. So those are two kind of basic strategies to begin the process.
Okay, that's it for the question. I did want to let everybody know that the slides that Annalise presented tonight will be included in the email with the link to the recording of tonight's program. So you will be getting a copy of the slides for those of you who asked. So I just want to say thank you, Annalise, and thank you all for joining us tonight. We invite you to make a gift to the Library Foundation to support our programs. And we hope you'll return next Wednesday, October 6th, for our Live from the Library program, Broadway's Golden Age, The Making of an American Art Form, with Rob Siedelman. More information and the registration link can be found on our website. Thank you again for attending, and good night.